Hi, it's Neil here with another weekly video insight. Well, we're nearly at the end of May, which can only mean one thing. There's just over 1 month to go till the end of financial year. And with only a month to go, now is the time to act and make the most of the opportunities available to you. I'm going to talk you through some quick tips, how to save yourself some tax and boost your super before the end of this financial year. Firstly, if you have a surplus income and you have some money sitting in your bank account that you don't need in the short term, consider making a personal contribution to your super fund. Virtually anyone can contribute up to $25,000 as a concessional contribution in one financial year, and then claim a tax deduction for that in your tax return. This can lead to significant savings in tax, especially if you're on a middle to high income, or perhaps you've incurred some capital gains that you're wanting to offset. Secondly, if you have significant assets outside of super, and especially if you're nearing retirement, you may want to consider making a non-concessional contribution of up to $100,000 this financial year. This will really boost your super balance and get that balance growing in that tax-effective super environment. And in some cases, you may even be eligible to contribute up to 3 years worth of contributions, so that's equivalent to $300,000 before the 30th of June. So it's a great way to boost your super balance. Thirdly, if your income or your spouse's income is less than $37,000, the next two tips could save you over $1,000. Firstly, it's the government co-contribution. And this means that if you're eligible earning under $37,000 for the year, you can contribute up to $1,000 into your super fund as an after-tax contribution, and the government will match this 50 cents for every dollar. So up to a maximum of $500 is contributed from the government to your super fund. Hey, bonus $500. Secondly, spouse contribution. If your spouse earns less than $37,000, you can contribute up to $3,000 to their super fund, and you can then claim a tax deduction for that spouse contribution of up to $540 on your tax return. So combined, those two will save you over $1,000. Now lastly, a word of caution for those of you who are already drawing a pension from their super balance. June is really the time of year to check that you have drawn or will be drawing the minimum required pension from that balance. And that is a percentage based on your age. So make sure you have a look into that, especially if you're running a self-managed super fund, because the onus is really up to you to make sure that you draw that minimum required pension. If you don't meet that minimum, then you will lose the tax exemption on your pension income, so you could be worse off. Okay, as with all superannuation legislation, it can get complex. There are exceptions to rules and eligibility criteria, so please do give me a call if you're looking to take advantage before the 30th of June. Get in touch now. Now's the time to act. All right, have a great weekend. Thank you for tuning in. See you next time.